When we want to start investing, the first question that pops into our minds is, how much money do I need? Will I have enough money to start investing for real? The answer to this question is 100% yes. We just need to find the right way to do it. And this is exactly an accumulation plan. So in this video, we're gonna see what is an accumulation plan and how to make one. Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. And if you love the subject, please consider subscribing. Of course, not everyone has a big sum of money to immediately dedicate to investments. When we start working, it takes various months, if not years, to reach a decently big capital to start investing. If then we assume that we will start working around 25 years old and maybe even later, we understand that things can get even scarier and we risk losing a lot of years that we could have dedicated to the growth of our capital. We already talked about compound interest and we understood how crucial it is in the world of investing. We also saw how a small difference in years of when we start our investment can lead to an extremely big difference in results in the long term. Therefore, the rule of thumb is always to start and to start as soon as possible. But how can I start if I don't have enough money? Well, you start anyways. And we do that with an accumulation plan. An investment is not something stagnant. We cannot invest our money once and then for the rest of our lives never think about it. An investment is a continuous process which has to follow us throughout our entire life. And an accumulation plan does exactly that. So then let's start talking about what is an accumulation plan. An accumulation plan is nothing more than a methodology in which instead of investing all the money once at the beginning, maybe because we don't have them or simply we don't want to invest all our money in one go, we choose to make our investments something periodic. We therefore decide to deposit in our portfolio a certain amount of money every month or maybe every semester. This is then done every month for basically ever. By using this method, instead of waiting to have a big capital, we can already start using the compound interest in our favor. Simply because even if we invest only $500, this will already start generating profit, which will then generate even more profit in the future. In this example, we can see the two scenarios. I decided to make the example with a 30 years investment at a 7% return rate. In both cases, we deposit $100 a month or $1,200 a year. In the first scenario, we start the investment with an accumulation plan methodology. In the second case, we decide to wait for the first 10 years to reach $12,000 of capital, to then continue depositing $1,200 a year for the remaining 20 years. As we can see, the difference is not small. In the first scenario, we have a result of a little bit more than $120,000, whereas in the second scenario, we have a little bit less than $100,000. There are $20,000 of difference that we literally decided to throw away for the simple fact that we wanted to wait to have enough money. $20,000 which don't come out of our pockets. Nothing changes on that side. Those $20,000 that we lost are from the markets, which obviously, if we don't invest, we cannot take. So let's see how to actually make an accumulation plan. First of all, let's talk about instruments. A big consideration that we have to make when we build an accumulation plan is that we are gonna make more or less frequent deposits. Whether these are every month or every 6 months, it's still kinda frequent. This makes it necessary for us to choose instruments which have a very low trading commissions. Since we are going to make frequent deposits, if we have trading commissions, this will of course eat into our profits. Another aspect connected to instruments that we're gonna choose is the management commissions. We actually need to choose instruments with low management fees. This is simply because if we do an accumulation plan, normally we do it with a very long time perspective. And in the very long term, even a difference of 0.1% yearly, exactly because of the compound interest, will become a big sum in the future. And when we talk about money that we have to pay in commissions, is never a good thing. Let's look at this chart where we have a return of 7% and a 6.8%. The difference is only 0.2%. With an initial capital of $30,000 and a time horizon of 30 years, we can see that the difference is 15 grand. Should we throw them away? I don't think so. We should also think about how much money and how often to deposit this money. We cannot really make deposits which are too small. Depositing $100 every month is probably going to result in high costs due to trading commissions, connected especially to brokers. But we're gonna talk about this in a bit. For this reason anyways, making less frequent but larger deposits like $600 every 6 months or $1,200 every year is certainly a better choice. Another consideration that we have to make is the composition of our portfolio, which has to be as simple as possible. If we decide to invest only $1,200, like in the first example, it means that at the beginning of our accumulation plan, we're gonna have exactly $1,200 to invest. And with the so little money, we cannot pretend to have a complex portfolio with options, certificates, and so on and so on. Another reason why our portfolio has to be simple is because, at least initially, we're gonna have to manage it ourselves. Asking a financial advisor to help us is probably gonna get tricky, simply because they have to be paid, and if our investment is only $1,200, finding an advisor that is gonna take the 0.5% of that is gonna be hard. He or she won't even be able to pay the gas for the car. Therefore, we will have to do some things ourselves, but don't worry, we're gonna talk about that as well. The last big consideration that we have to make is diversification. We said that our portfolio should be simple, but this is not an excuse not to have it diversified. It's actually crucial to take diversification into account and never leave it last or neglect it. Making our portfolio simpler does not mean making it less diversified, and we're gonna talk about this in a moment as well. So, to summarize briefly, low cost, simplicity, and diversification. These three rules lead us to a single conclusion, and you already know perhaps what I mean. Yes, our dear ETFs. I know, lovers of actively managed funds will already think that I invented these three rules only to be able to insert ETFs, but I'm sorry to tell you that this is not the case. In fact, if you think about it a little bit logically, you will understand very quickly that ETFs are very useful tools to be used in accumulation plan. Let's see the reasons. ETFs are extremely inexpensive instruments, both in terms of the price of the single ETFs on the exchange, which many times is around $30, $50, maybe $100, and in terms of annual cost to maintain it, which is around 0.05% to 0.2% in most cases. This certainly makes it a very good tool for all those small capitals, and if we talk about accumulation plans, about small capitals, at least initially, we speak. Second reason why ETFs are a great tool for the accumulation plan is their ease of trade. ETFs can be bought and sold always, instantly, from Monday to Friday, from when it opens to when it closes, the exchange on which you want to exchange them. They are in fact completely available, and it is very easy to find someone who sells or buys them. They are therefore super liquid instruments, perfect for anyone who wants to make a periodic deposit into their portfolio. ETFs have no entry fees. In fact, the only costs to which unfortunately we must be careful are those of the broker, the so-called commissions. By choosing the right broker, however, the commission can really become a very low figure, even zero in some cases. And hey, let me know if you want me to talk about brokers to compare some options that we have. ETFs are super diversified, and I know exactly what is inside and what returns I can expect on average. ETFs track indices, so I know exactly what it is in my portfolio. I know how diversified I am and on which markets and or companies and or countries I am exposed to exactly. One of the most diversified equity indices is the MSCI World, which covers the entire world economy. In order for this index to fail, the world economy must fail. These are just some positive aspects of ETFs. They make them a very interesting and valid tool to be used with an accumulation investing methodology. So when I talk about the ETF, it's not that I talk about it because I make money out of it or because someone pays me to do it. They are simply the tool that today is the best for this and for many other purposes. And if someone comes up with a better tool, I'll be the first one to use it. As for the active managed funds, unfortunately, they are absolutely not recommended, both in general terms, but especially for an accumulation plan, as they have really high costs. Now, I know that you hope that I talk about how to choose an index to be included in your portfolio, but unfortunately, I can't do it. I have been asked in the past to talk about which index I chose. Well, it's the MSCI World. I'm 20 years old and my time horizon is around 30-40 years, so making 100% equity is a good choice. I don't have a large capital, so I decided to use only one ETF. As we said earlier, simplicity in our portfolio when we make an accumulation plan is necessary, so one ETF is more than enough. When the capital starts growing, we can always add more ETFs. Obviously, be careful. I don't invite anyone to copy what I do. I simply answer the question that was asked. We already talked in the past about how to invest, and we understood that investing is something extremely personal. There would not be all these ETFs and all these instruments if it were not that some people need something and other people need something else. Therefore, you need to understand your goals, your risk tolerance, your financial situation, and so on. My decision is based on me, and your decision must be based on you. However, choosing ETFs as a tool to make an accumulation plan remains an excellent choice for practically everyone. It's just a matter of choosing the most suitable index and the most suitable ETF. I hope you found this video useful and that you liked it, but let me know in the comments if you already are doing an accumulation plan or if you do think to do it in the future. Also, let me know which tools and indices you prefer. Finally, if you like the video, please leave it a like. This is one of the few ways that I have to see if you like the videos, and therefore keep posting. As always though, I'll see you in the next video.